Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about the 3 biggest retirement traps that we see people come in our office with. And this is from Canadian retirees, and we talked to a lot of people in the States and abroad as well, and it's the same situation. I'm working with the person at my bank or financial institution, and they say I'm going to be okay. Or they put a plan together, but it doesn't line up with what you talk about on the channel, Adam, and I'm concerned maybe that our plan isn't the best for us. And it's costing you guys as Canadians, as Americans, wherever you live, it's costing you in retirement tens to hundreds, honestly, hundreds of thousands of dollars. And there's simple mistakes that you can correct starting today, revamp your retirement plan, and put that money back in your pocket. So let's cover that. Before we jump into the content, if you haven't already subscribed to the channel, please hit the subscribe button. It takes 1 second, it costs you nothing. And if you enjoy these videos, hit the thumbs up. We need this content to get out to more Canadians. Canadians don't understand how to plan for retirement, the majority of Canadians. We're trying to create that environment here to educate, to help people out across Canada, across the world really, on how to make better decisions heading into and through retirement. So if you enjoy these videos, hit the thumbs up button. So the biggest retirement trap that we see come in our office by far is taking CPP early. And this is often the plan that the bank or most financial institutions will tell you. And it's a bit of a conflict of interest. I talk about this a lot on the channel, and I think I could do a video every single week on this and still not get it through to a lot of you. So hopefully you take this and run with it and actually make changes in your financial plan. But a lot of you'll go to your bank or financial institution. A lot of times we hear that that plan is a verbal, you're going to be okay in retirement, which is scary to think that that's a financial plan. But part of the plan that we're seeing mostly come through is to take your CPP right away. Whether you're retiring at 60 or 65 or somewhere in between, as soon as you retire, take CPP. Don't touch your RRSPs. We want to hold your RRSPs forever and let that compound and grow, but take your CPP. And I've shown it in our software. I'll show it again in a future video on our software. That never makes sense. You take your CPP early if you have a health issue or if you have some family health issues. Like there's a few underlying issues, and we've done some videos on that, on why you should take CPP at 60 or even at 65. But for 99% of you, if you want the most money in your pocket in retirement, you want to defer CPP till 70 or at least closer to 70, somewhere between 65 and 70. That's typically 68, 69 is typically the kind of the sweet spot for 70 for a lot of you. Yeah, but Adam, I can get my money now and blah, blah, blah. Trust me, if I put a financial plan together for you, took all your information, shoved it in and said, you're going to live till 75, it's still worth it. You won't believe me, but I will do some more videos going forward on this and actually show you in the software. Like, it's really hard to map out a strategy taking CPP at 60 that makes any sense at all from an income or a tax perspective. A lot of you, I can't convince otherwise, right? This is your belief. I'm taking it. It's government money. I want it as soon as possible. Maybe you have the old school mentality, or maybe you come from the States where the social security system is not in the best financial situation. But the Canadian pension plan is. It's a well-managed plan. It's well-funded. It's actually funded for well over 70 years. A lot of you still don't believe that, so you take it at 60 thinking it's going to go away sometime soon. Not the case, it's there. So make sure if you have a financial plan put together for you and it tells you to take your CPP at 60, 65, or somewhere quite early in retirement, you might want to rethink that and also have your financial planner put a plan together. What are the numbers if I take CPP at retirement, if it's before 65, at 65 and at 70? What's the total income difference if I take CPP at different times? Because I guarantee you, because I do these 100 times over, closer to 70 is going to make more sense, giving you more money and paying less taxes. The second biggest retirement trap that we see is, and it kind of ties into number one, is that your plan doesn't have you drawing down your registered accounts quick enough. When I look at financial plans put together that a lot of you have, a lot of you will come to us saying, Adam, I have a plan put together. It doesn't make sense based on what you're telling me. They send me the plan, I look at it, and sure enough, CPP is taken early, like I talked about. The second thing is the RSPs aren't touched till 71, and it's the minimum amount. And by the time they're in their late 80s, they still have like $300,000, $400,000, $500,000 in the RSP or the RIF at that point. The problem with that is when you pass away, sure, if you have a spouse or common law, it goes to them, but when they pass away, it's taxable income. That money is added to income in year of death, and thus you're going to lose about half of it to taxes. And so you want to make sure you have a tax strategy on drawing down that registered income. So if you retire, we have clients retiring in their 50s, we start drawing down that registered money right away, especially locked in. If you have a lira, convert it to a LIF, start drawing it down right away, the maximum amount. that needs to happen right away. When I say registered, I don't mean TFSA. TFSA is technically a registered account. I mean RRSP, LIRA accounts, any DCPP, like pension stuff that you have, anything like that, that when you die is going to be a taxable income to you. You want to start drawing that down and kind of level it out. Typically, you want to draw that out early, defer your CPP, and then when your CPP starts, keep drawing down your registered accounts if they're still there, but just at a slower rate to complement your CPP and OAS. So that's kind of the best flow to things. But again, if your financial plan shows your RIF starting at 71 and you're retiring, 60, 65, that's a problem. You're leaving a lot of money on the table and you're paying CRA way more tax than you need to pay them. When we build out a financial plan, if I can give the client more after-tax money, pay less tax overall to CRA, both while you're alive and on your estate, and create a larger net after-tax estate when you pass away, those are the three things we're trying to accomplish in a plan. And typically we can do all three. Sometimes we can improve two and keep one the same. Maybe your estate stays the same, but there's way more money in your pocket and less money to CRA. But again, the first two traps I've talked about, CPP early and not drawing down your registered accounts early enough, those two things will definitely make us not be able to check off those boxes. It's giving you less money in your pocket and more to CRA if you're following those first two traps that we talked about. The third trap that most of you fall into is not following a laddered strategy in retirement. And I stress it a lot. Again, we just did a video on this. When you hit retirement, you want the first part of your retirement to be more income than the second and then more than the third. A lot of you get to retirement and the plan that you have in place just has a flatline income. It's saying you get $60,000 today and when you're 90. But your ability to spend more and your desire to spend more now is much greater, right? You don't need 60 later, but it'd be sure nice to have 70 now. So why not take 70 now, then 60, then 50, something like that, right? Like the math, you got to make sure the math works out, obviously. But it's that ladder strategy income of the go, slow, go, no-go phase. And most plans that we see come through our office don't have any type of ladder strategy. And to be honest with you, when we ask the client, go back to your advisor, like here's a few tweaks that you need on the plan and ask them to create that ladder strategy. 99% of the time, the client comes back and says, Adam, my financial advisor says they can't do the ladder strategy. The software doesn't run it or do it or whatever. That's just laziness from the financial planner. Our software doesn't do the ladder strategy either. We go in and override it. And a lot of people think, Adam, if we hire your firm, you're basically taking our information, you're putting it into, your snap projection software that you use, hit generate, and it spits everything out. That's kind of step one of many. So when we create a financial plan, we're typically running out 30, 40, 50, sometimes up to 100 scenarios because we're playing with numbers along the way to see how do we optimize this along the way. Part of that is, the RRSP meltdown, the timing on the CPP, like they have to kind of coincide with each other. Everything needs to work together. I was talking about that too. The income silos. How do your income silos come together as one to give you the most money and to pay the least amount of tax? And so make sure that within your plan, you have more income in year 1 to maybe 10, maybe up to year 15 if you're retiring early. And a lot of you fall into the trap of, I have a plan, it's just a level income. What that's doing is it's not giving you enough early and it's going to leave you a bit of a nest egg later on that you can't spend. So there's the 3 biggest traps that we see come in our office. And again, it's not, I'm grabbing 3 from 10 that we see always. Like we see the same 3 traps day after day after day. People taking their CPP early, they're deferring their RRSPs, and they're taking a level income for retirement. That's a bad plan. You want to revamp that plan, whether it's with your financial planner, reach out to our office, get help, get that plan revamped. It's never too late. We've revamped some plans for people in their 70s, early 80s. Again, the earlier you do it, the better off you're going to be, but make sure that there's certain things that you don't fall trapped to that we see probably 99% of the time in financial plans. So hopefully that helped you guys out. Thank you for joining us in this video. We'll see you in the next one.